here.
All right, let's talk a little bit more. Sorry about that sidebar. I hope it answers some questions. I'll get Kristen to come in and do the math because she explains it better than I. Of course, she explains everything better than I do. Real quick, we did the math. We're going to talk about a couple more things. Before we move on real fast, I did want to make in full disclosure in front of everybody, I may or may not be here the entire time on Wednesday. So Yasmin, who is an up-and-coming instructor, will be here as well. She has filled in for me, classes for me, but she is preparing to be here on Wednesday? Yeah, Wednesday. And so she may be your instructor. And I may be around. The reason being is I'm teaching at the Board of Realtors all day, so I had to be there from 8 to 12, so it would put me teaching 12 hours straight. So not sure I'd make it, to be honest. I'm not sure you'd want me here, because I'd be like, at 8 o'clock, I'm ready. That might be a little bit. So,
We've been at work.
8 to 12, what?
I'm teaching at the Board of Realtors. I teach CE as well.
That's your CE class about something I seen a post.
There you go. That's all. So I'll be teaching that all day. I got 42 people coming to ethics on Wednesday.
Oh, yeah.
Yeah, that'd be really good. So real quick, let's continue our conversation about the loans. I'm glad we got through that math because I wanted to be the one to explain the 28-36% ratios because I think that's, a lot of people do it different ways. And again, there's extra problems in your math book. But for me, the only way that I get through those problems is I just had to think, why am I doing this? What does this mean to me? And so you saw there was no formula, right? I didn't do a formula. I just rationed it. You can look in your book. It's going to show you the T-bar. It's going to show you how to apply the T-bar. You can do it algebraically. There's many different ways. Stephen's way is not always the best way. It just works for Stephen. Like I said, if you haven't seen Travis Everett's videos on YouTube, you can watch him. He'll teach you a whole different way. It's his whole pre-license class. He's an instructor just like me for the Real Estate Commission. He teaches his class, I think, Easterly somewhere. But he has all his videos on YouTube. His are way better than mine. He's funnier than me too, so you'll like that.
I hate his voice.
Yeah, I'm not a big fan, but he does have a good sense of humor. So remember when we're talking about lending, we're talking about value. Yeah, he's an odd dude. He's kind of an odd dude. I like him, but he's an odd dude. He hosted the Educators Conference. He was like MC at the conference. He was funny.
What's the guy for Southport, the teacher?
That was from 1985.
The teacher also? All right.
All I can remember is somebody killed Kenny.
That's what we sound like.
All right, so remember appraisal. What does an appraisal give you?
Value.
What does a lender care about when giving you a loan? Appraised value. They don't care what you're paying for it. They don't care what you CMA'd it or what your probable sales price, or even what the buyer's willing to pay. It's always going to go off of the value. And that's what the appraiser is there for. Couple of things with the lending process. They're going to require you to get title insurance if you're getting a loan. We talked a little bit about title insurance. Who does it protect?
The lender? Well,
It depends. Remember, with title insurance, there's two policies, right? What's one of them? The lender policy and the owner policy. Who's the lender policy protect? The lender. Who's the owner policy protect? That's right.
That one's extra.
That's actually, if you don't ask for it, you may not get it. And it is meant to protect against someone who might show up as a third party saying, hey, that's my property, or I have this easement, or whatever the issue is. That title insurance is basically giving you an opinion of title that everything's nice and clear, no worries. If anything comes up, we'll take care of it for you. A little safety blanket.
Which is the one you have to ask for?
The owner's policy. The lender's going to make sure it's on there because the lender's going to cover their butt. If you don't ask for the owner policy, though, you may or may not get it. It's really cheap. It's not much. And some attorneys will just put it all in one.
So then you will, if you didn't have the owner policy, then you would be liable?
You could expose yourself potentially. Because the lender policy is there, it's going to protect their financial investment. But if something came up, the lender would get their financial investment fixed. You as the owner may lose out on all of your expenses to procure said property, i.e. your down payments, your inspections, any tax bills you'd be out, mortgage payments, things like that. So yeah, it's definitely going to set the lender whole. It may not set you whole. You may have to move out. Yeah.
It's a little off subject, but if the lender doesn't require a survey, I mean, really and truly,
Right.
I mean, at what point are we going to be like, you need to have a survey? I mean, if the lender doesn't require it,
Every time.
you're not.
The reason being is because every buyer you work with, you are going to recommend a survey. And you're going to let them tell you whether they want it or not. Because the only way to know about encroachments is survey. It's not our job to say you do or do not need it. It is, here is a survey, here are some approximate costs. Would you like one, yes or no? If you have the survey, you could get the extended title insurance policy that protects against
Encroachment.
encroachments. It's going to insure against those encroachments because we know we have a survey saying there are none. So if any show up, we know it wasn't there. So again, they like giving insurance when they know they got something that's easy to insure. But I would always, and we'll talk about it more in the closing section, but you're always going to recommend all of it, pretty much everything. We're going to recommend everything and let them opt out. And we have a form, it's not a requirement, but we will do it as realtors. Professional services disclosure form. It says appraisal. Do you want it? Yes or no? And they initial, yes I want it, no I waived it. That's a cover your butt form. That says I told you you could get a survey, you selected that you wanted to waive. So don't call me about that encroachment. I told you you could get it. Otherwise they're going to say, hey, you didn't tell me about a survey, I didn't get one of those because you told me not. No! See right here? I even told you about it and you initialed. You didn't want it. Don't you come looking at me like that. No. So that is very important. I would always echo that you recommend home inspections, termite survey. Actually, I think a copy of the professional services disclosure form is in the appendix of your textbook, but if not, we'll look at it. Because it's not a required form by the commission, but it is a required form from my office and pretty much most offices that are going to protect their butts because of that right there. Somebody can't show up and say, oh, I got an encroachment, you didn't tell me about it. You didn't tell me I needed a survey, or I could get a survey. Yes, I'm going to tell you, you have the option of getting a survey. It's up to you whether you want to pay for it. So yeah, I always recommend them. Don't ever be the guy that's like, oh, look, there's the mow line. Nope, that's not me. I'm not a surveyor.
Can you add that cost into like the closing costs? And
You can, yep. So
Is that what it pays?
some of those inspections are allowable closing costs. It's going to depend on the lender and what they'll allow and the cost of them. A survey on a large tract of land can be quite exorbitant. I mean, several thousand. So you may not get it all covered, but a small tract's probably going to be less than $750, and that could be included into your closing costs. Absolutely. Does the buyer still qualify? Remember this? What did Natalie say they do right before closing?
Credit refresh.
Yeah, they're going to check it out one more time. So do not change anything from the time you apply. Actually, I had a realtor buddy who had those little no smoking signs, you know, little circle with a line through it, and they were stickers. And he'd get them out when he took you as a buyer. He said, get out your credit cards. And he put them on the credit cards. He said, don't use them. Not till we're done. When we're done, you can whip those things out. But any new credit, anything, it could change everything. So it could kick the loan, and you do not want to do that, especially if you're past your due diligence period. Because what if they do this credit refresh 2 days before closing, and your buyer has opened up a line of rooms to go and filled it all the way up? Now they don't get a loan, and they lose their earnest money, and they have a pile of furniture with nowhere to put it. Yeah, that's not good. You can hold it for them. Loan commitment, that is when we're ready to go. Remember from our process, application, processing, underwriting, send the money, close. That's good. Now, a lot of people call it settlement or closing. Remember, the settlement is the signing, closing is the recording, right? Recording is when we get paid. Clear to close, that means that we've kind of cleared underwriting. That's the goal. When you get a clear to close, those are musical words. Like, you're just excited to hear that. Because Natalie calls and said, hey, Stephen, on your buyer on 123 Main Street, we got a clear to close. Great. I know right now they have money. They have money. So nice. We don't have to worry about it. We are good. So that's a good day. But remember, new financing could throw that out of whack in a minute. So we record a mortgage to establish a lien priority. If there is a payoff, you would have a satisfaction or release of mortgage. That means it's been paid, satisfied. And then remember that right of reconveyance, where does that go to? What does that mean, that right of reconveyance in the deed of trust?
The paid deed goes back to the.
Yeah, once it's paid for, we're going to file the satisfaction. The reconveyance deed or the right of reconveyance returns full legal title back to me as owner. Because now I own it. There's no encumbrances. That loan is gone. CFPB, anybody know what it stands for?
Complying.
Let's get try. Consumer Finance Protection Bureau. You're close. It has B. They both have B's. Consumer Finance Protection Bureau. If you have not heard of CFPB, you will, as a realtor, learn them very quickly. So kind of a little backstory on the CFPB. They were created as a result of the recession. the thought process here was consumers are getting duped on financing. So we're going to create this bureau that says we will protect consumers in any kind of financing process. This engaged in car loans, house loans, it was just financing in general, so that we weren't kind of subject to predatory lending. Their initial creation was the historical in that fact, but also in the fact that it also had zero oversight. It was the first entity ever created in the federal government that did not answer to any branch of the federal government, not judicial, legislative, or executive branches. So no one had oversight, which essentially created a nice little dictatorship. So they used that opportunity then to completely overhaul our closing process. So they went through and created a Dodd-Frank Act. The Dodd-Frank Act got rid of the HUD from a financing perspective and created these closing disclosures that we're going to talk about in this class. And so their goal is to, or their intention, is to simplify, clarify, make sure that when you're signing on the dotted line, you are very clear on what you're signing on. There is no, oh, I didn't know about that balloon payment. I didn't know about that rate going up. I didn't know about those escalated payments. It's going to be real clear when you sign on the dotted line that you know what you're getting into. So CFPB was the one that was in charge of that. Their entire kind of goal was that everybody should know before they owe. So the Consumer Financing Protection Bureau, CFPB, established by the Dodd-Frank Act, Dodd-Frank Wall Street Act reform, and the Consumer Act was the one that kind of was tasked with overhauling this process to simplify financing so that there was less predatory financing. Not just homes, any kind of consumer financing, credit cards, car loans, loan payments, mortgages. Now that you are aware of this, you will start watching it. If you apply for, actually I did this the other day, last year, I got a car loan, and I saw a disclosure, it was a lending disclosure. It looked just like our mortgage lending disclosure. It's because of this. Dodd-Frank said, hey, if you're financing any kind of big ticket items, we need to make sure you know, is there a prepayment penalty? What are the terms? What are your interest rate? What's your approximate monthly payment? Is there a balloon? Is it fully amortized? It goes zero. They do enforce and issue the financial rules, including Truth in Lending, Fair Credit Reporting Act, and Equal Credit Reporting Act. We're going to talk about these guys. By the way, RESPA down here, we're going to talk about them too. Anybody know what that is? Good rule in real estate. Anytime you see RE, it probably stands for real estate. So, Real Estate Settlement Procedures Act. And we'll talk about that one too. TRID. So, TRID is the Truth in Lending RESPA Integrated Disclosure. Mouthful. Yeah. Truth in Lending Integrated Disclosure. It can delay your closing because, as we talked about with Natalie, if something changes substantially, that's going to, again, know before you owe. If something changes, you need a couple of days to think about it. So then the lender has to comply with those disclosure periods. Again, the loan estimate up front, 3 days from application. Proposed closing statement reviewed 3 days before closing. So you have to meet those. It does impact the lenders. It does impact them against the Dodd-Frank because they can be liable if they don't. Now, this is important. Regulation Z. Regulation Z, is under the Truth in Lending Act. So, kind of CFPB governs all of this, right? They're on the umbrella. So, Regulation Z, under Truth in Lending, says we can say some things as brokers. There are some things we cannot say.
Bless you.
Thank you.
Anytime you hear on the radio, hey, get this house or this car for $5.99 a month. You just hear at the very end of the commercial, based on today's your MVR, your credit score, blah, blah, blah. Is that little micro machine guy talk so fast? That's the full disclosure. Regulation Z says basically when you say numbers, you have to have a full disclosure of how did you get to those numbers. What does it take for me to get that number? So if you say payments as low as $100 a month, great. What do I have to do to get there based on a consumer finance, or based on 800 credit score, based on number of payments? So they kind of put the little fine print in the post after. And you'll see it on a flyer too. I don't think we have any from Natalie. But you'll see at the bottom of, here's anytime you get a flyer, there's always going to be a tiny print at the bottom. Anytime, this one doesn't really address it. But if you have it, for example, if this was a hot flyer on your house and it said, hey, this qualifies for a 100% USDA loan at a 3% interest rate. Well, then at the bottom, it would say what it takes to get all that. You gotta have a certain credit score, you gotta have income, things like that. Is there anything else I need to talk about now? Know before you have this what it'll cost me, for what fees, prepayment, also any marketing regulations, because it governs what we can and cannot say. So Truth in Lending RESPA integrated disclosure requires loan estimate and closing disclosures. We're going to talk about more of that in the closing section. We did talk a little bit about it today, so you know what it looks like. This is kind of a snapshot of what these closing disclosures and loan estimates look like. It says real clear on the top, this is the loan estimate. You're borrowing this amount. Here's your interest rate. That's what your monthly payment's going to be. Can this change? No, no, no. Does it have these features? Prepayment penalty? Yes. Here's what it looks like. Balloon payment? No. The goal is you should be able to look at one little paragraph and figure out what you're biting off. Really meant to be transparent. Not always, but meant to be. It's going to include, yeah.
I'm sorry, what did you say RESPA stood for?
Real Estate Settlement Procedures Act. Real Estate Settlement Procedure Act. Basically, it governs how we settle a real estate closing. One of the biggest things that it says is that until we're funded and recorded, no monies can be moved. It's the disbursement of funds, government. Also talks about some of these disclosure laws that have to happen. So, APR, annual percentage rate, number of payments, amount of payments, finance charges, all of this is going to be in here. These finance charges in particular, because back in the day, lenders would have, believe it or not, junk fees. And as brokers, we'd call them out. Like, that's a junk fee. What is that? I don't know. Get it off there. They would put it on there, and if you signed it, they could charge you for it. Well, it would be like a shipping and handling. Why? What are we doing? Junk fee. Pull it off. So now it has all those finance charges lined up. This is the loan origination fee. Cool. That's what the lenders get paid. I get that. Some banks would just throw in these fees. I'm like, why we have this? We don't need this. So we had to be a little more vigilant. Now they're much more in line and competitive. But Regulation Z limits what can be said without that further disclosure. So I can say some things without giving full disclosure, a little Micro Machine Man, and some things I can't. Particularly numbers. If I start saying numbers, I need full disclosure. So which of these would be okay for you to say without a full disclosure under Regulation Z?
Low down payment.
Low down payment, that's cool. That's relative. Low could be like 50,000, could be 5,000, depending on what is relative. What are you comparing it to? Zero down. Everybody gonna get zero down? No. That 580 credit score who's had a credit card for 2 years, they're probably not gonna get zero down. So that's gonna be reserved for good credit, you're really not high risk people. So again, that would require, hey, if you're getting zero down, this is what it takes. Full disclosure of all the terms. No numbers, typically including zero down. Gentler terms are okay. Monthly payments, down payments, number of payments, finance charges, term of loan, these are all trigger terms. Now, as with every rule in this class, I have to teach you the exception, right? So, APR, oops, right here. APR is not a trigger term. We'll talk about it again in a second. But again, this rule says if you say any one of these, you're going to have to disclose them all, including APR. What is APR? What does it stand for? Annual percentage rate. Anybody know what that means? Yeah, no, not many people do. You do? Go ahead.
Well, if I understand it correctly, your rate is the rate on the loan for the loan amount, and then the yield is including all of the fees that you pay.
Yeah, pretty much. That's. I think I heard you say. What did you say?
Basically.